Extracting gold requires massive upfront capital and navigating complex geopolitical landscapes. For many operators, extreme conditions and regional risks routinely crush profitability. Against that backdrop of constant volatility, Agnico Eagle maintains a streak that defies sector norms. They have paid a cash dividend to shareholders every single year since 1983. That 43-year consistency is built on a strictly defensive geographic footprint. The company operates exclusively within politically stable mining jurisdictions like Canada, Australia, Finland, and Mexico. By rooting their operations in regions that respect property rights and the rule of law, they have constructed a financial fortress designed to outlast deep macroeconomic storms. Inside that fortress, Agnico Eagle runs an aggressive revenue model. They maintain a strict internal policy of zero forward gold sales. By refusing to hedge their production, they never lock in future sale prices. When gold rallies, they capture 100% of the financial upside. This high-wire revenue model is anchored by their regional operating hubs. Procurement and supply chains are deeply localized across North America, Europe, and Australia. If a global shipping bottleneck chokes international freight, these local supply networks insulate their daily operations from disruption. This operational stability provides the predictable cost base necessary to sustain their policy of full exposure to gold price movements. This specific combination, maximum commodity price exposure backed by localized operations, is the engine driving current profitability. In the first quarter of 2026, that engine produced over $4 billion in top-line revenue. While high revenue is expected during a gold rally, the core of this report is the significant widening of their operating margins. This chart compares year-over-year net income. Q1 2025 sat at $814.7 million. In Q1 2026, that figure rose to $1.69 billion. In exactly 12 months, they essentially doubled their net profit. That margin growth flooded the balance sheet, pushing their net cash position to approximately $2.9 billion by the end of March. That level of liquidity forced a recalculation from debt agencies. Fitch officially upgraded Agnico Eagle's long-term issuer default rating to A- in April. These results indicate that Agnico Eagle is translating current market conditions into a significantly strengthened balance sheet relative to their peers. On the recent Q1 earnings call, management detailed exactly how they plan to deploy this $2.9 billion cash pile. Their primary playbook involves reinvesting heavily into 5 key value driver projects to grow production, while simultaneously returning capital to shareholders through share buybacks. But the call also detailed severe macroeconomic headwinds. Persistent freight inflation and volatile global fuel prices continue to pressure their cost guidance. Internally, the most significant risk factor discussed was the proposed acquisition of Rupert Resources, located here in Finland, and the potential for shareholder dilution that comes with the buyout. To mitigate this, management outlined a strategy to sell off non-core portfolio investments and channel those proceeds directly into additional share repurchases. It is a complex tightrope walk. They are leveraging their cash reserves to fund future growth without overextending the shareholders who built the foundation. That leaves potential investors weighing significant upside against harsh macroeconomic realities. The bull case is clear. Agnico Eagle is an A-rated producer, anchored in stable jurisdictions, with total unhedged exposure to the rising price of gold. The bear case points to their vulnerability to global inflation, their reliance on a commodity price they cannot control, and the high execution risks tied to the Rupert acquisition. Does the fortress hold strong, or will the mounting costs of expansion drag the stock down? Let us know your take in the comments. If you want more deep dive cinematic breakdowns and company updates, hit the like button and subscribe to the channel. As always, this video is for educational purposes only. Always conduct your own research before making any financial investment decisions.